lower inflation reading proves good news for Rachel Reeves, but what's next for the gilt market? Gilt yields fell by around 10 basis points across the curve on Wednesday as UK inflation unexpectedly held steady at 3.8% and traders upped their bets that the Bank of England does, after all, cut rates this year. Falling government bond yields are a global trend. US Treasuries have slid in recent days as investors bet that the Federal Reserve will be driven by concerns over employment, almost regardless of the level of inflation. Sarang Kulkami is lead portfolio manager of the Vanguard Global Credit Bond Fund. Sarang, let's start in the gilt market. Gilts looked a pretty unfashionable buy lately, to say the least, but does the rally have further to go?
Good morning. Yes, we still like the gilt market over here. To start off with, I think there's been a lot of I'd probably say negative sentiment priced into it already. And, with good reason as well. Of course, you've had challenges around the budget. You've had rising in, high inflation levels, sticky inflation. And, a lot of this has kind of resulted in the yield premia in the gilts market actually looking quite attractive. So if you look at the real yields to start off with, they're much higher than where they have been in the past. And if you look at term premium, the difference between the front end of the gilt curve around 10 years and 30 years, each of these points now, include this increasing premium, which is quite attractive.
Do bond traders really think the Bank of England will cut this year, though? Will inflation give them space to do that?
This year, it may be tough, but I don't think a lot of people are just focused on the next meeting, to be honest. I mean, the transition that we're seeing from 2025 to 2026 is going to be quite important because you are seeing inflation slowing down quite a lot. You are actually seeing growth slowing down a bit, and you're actually seeing expected improvement in government deficit figures as well. So the combination of these three actually, I think a lot of gilt traders will be looking into 2026 and not just what the Bank of England would be doing. I think the Bank of England are being cautious because they do know that, in segments of the economy that have been keeping inflation inflated, you could set this long-term trend that could get embedded. So they would rather err on the side of caution and delay it a bit, but I don't really think that traders are going to be waiting for the Bank of England to set that way. They know that the direction is going to be lower. The timing of that is obviously not something that is 100% certain.
There's a clear direction in government bond yields around the world in recent days. US Treasuries are down as more Fed cuts are expected. But what does it mean for the bond market if the Fed keeps cutting, even with higher inflation?
With government bond markets, it's a very, very interesting space right now. And part of that has got to do with there's such a big difference in terms of the information that you're getting from a macro perspective and from a bottom-up perspective. If you think about it, first of all, in the US, you have an absence of data coming from the government. We have budget issues coming up in the UK. We've got, budget discussions still to go through in France. You've got supply side changes coming through in Europe. And when you take, and in the backdrop of that, you obviously have the trade war going on between the US and China and where that is eventually going to end up. And when you compare that to information that's coming from a bottom-up perspective, where you look at corporate earnings, they're actually quite good. So you have been actually seeing a level of yield sort of responding to the fact, as I mentioned, this transition that's happening between 2025 and 2026, where if you look at all three major regions, you will actually see, slow down in growth and inflation and that's supporting. In the US, I would say compared to other markets, the front end has a lot of, I'd say, good news priced into it, around 5 odd, rate cuts that have been priced in. And so that's probably not the place where we think is the most attractive place from a yield perspective. I mean, I think you can get better options either in sterling or other parts in the world where the front end where we think is much better kind of valued.
You mentioned the lack of data as the US shutdown is now more than 3 weeks long. Is that a concern for the bond market?
There is some information that's still feeding through, mostly from bottom-up corporate earnings, as you mentioned. outlooks that are being provided by companies. So it's not like a total absence of that data that you have. But, I think, yes, the longer it goes on, it does kind of like raise some concerns about whether parts of the government that need to keep functioning, without workers being paid, whether that can continue to function as smoothly as it has so far.
That was Sarang Kulkami of Vanguard. Don't forget you can watch more videos on Reuters.com.